Welcome to This Explainer. Look, whether you're cramming for a midterm or just trying to solidify the basics, you are in the exact right place. As future accountants, measuring business income is literally one of the most critical functions you're going to perform. So today, let's just dive right into this study guide. We'll be mapping out the what, the how, and the why of business income, breaking down the exact principles that govern it all so you can absolutely ace those exams.
Here's our roadmap for today's explainer. 1. Defining business income. 2. Core principles of measurement. 3. Primary objectives of income. And 4. A quick study guide wrap-up. Let's get right into it.
Section 1, defining business income and establishing our baseline. You really can't measure what you can't define, so let's set up our foundational vocabulary first. At its absolute core, business income is simply the surplus of revenue over the expenses incurred by an enterprise. It's kind of like the ultimate financial scoreboard. If you've got a positive surplus, well, the business is generating wealth. Simple, right? But to accurately arrive at this one all-important number, the whole measurement process relies heavily on the careful estimation of two very distinct things: revenues and expenses. So to calculate that surplus, we first got to estimate revenues. Now, in strict accounting terms, revenue is the consideration recovered by the business for actually rendering goods and services. It's that sweet inflow of economic benefit. But notice the wording here, it's super important. It's about the consideration recovered for the act of providing those goods and services. Like if you fix a client's computer, your revenue is the fee you've actually earned for doing that specific service. And then, of course, we subtract our expenses. These are defined strictly as the expired costs, basically the resources that are actually consumed in the process of producing that specific revenue. It is not just money spent willy-nilly, it's the cost of the resources completely used up to generate those inflows we were just talking about. All right, moving on to Section 2, Core Principles of Measurement, or as I like to call it, the rules of the game. Now that we know what we're measuring, let's see how the 4 core accounting principles govern this entire process. Principle number 1 is the realization concept, though you'll often hear it called the revenue recognition principle. This rule lays down the law. Revenue is recognized by the seller only when it is actually earned. Honestly, it absolutely does not matter if the cash has actually hit your bank account yet. Here's a massive pro tip for your exams. When you're selling goods, revenue is recognized the moment the risks and rewards of ownership transfer to the buyer. For services, it's based on the stage of contract completion. This rule is a total game changer because it ensures the income statement reflects the true extent of revenue earned. It completely mitigates that crazy volatility you'd see if we just reported based purely on cash inflows. Next up is the accrual concept. This is a massive pillar in accounting. Under this rule, revenue is accrued in the specific accounting period it's earned, and expenses are recorded based on when they're actually incurred to produce that revenue. Once again, we are completely ignoring when the cash is actually paid out or received. Just block that out. So the crucial takeaway here, and definitely star this for your exam, is this stark contrast. Receiving cash and actually earning revenue are two completely different things under the accrual concept. Think about it. You could receive $1 million in cash today for services you haven't even started providing yet. Is that revenue? No, not yet. You absolutely must separate the cash movement from the economic earning process. Okay, principle number 3 is the matching concept. This one is absolutely essential if we want to accurately measure profit or loss for an accounting year. If you want a true, honest picture of performance, you simply can't just mix and match revenues and expenses from completely different time periods. The logical flow here happens in 3 simple steps. First, pinpoint the revenues earned in a specific period. Second, identify the expired costs, those expenses incurred during that exact same time. And third, directly match those expenses against the same period revenues. This perfect pairing right here is exactly what gives us a reliable, honest profit figure. Our 4th and final rule is the conservatism or prudence concept. Think of this principle as the ultimate safety net of accounting. It basically ensures that business income is never, ever artificially overstated before profits are fully realized. It keeps us, accountants, cautious and stops companies from painting an overly rosy, unrealistic picture of their finances. Now, really pay attention to this golden rule because you should definitely commit it to memory. As an accountant, you must operate on this exact premise. Anticipate no profits, but anticipate all losses. It sounds a bit pessimistic, I know, but if there's a likely loss on the horizon, you record it. If there's a potential profit, well, you wait until it is undeniably 100% earned.
All right, Section 3, Primary Objectives of Income, and the stakeholders who care about it. We know the what and the how, so let's shift gears to the why. Why do we go through all this meticulous effort to measure income?
Well, here's your summary cheat sheet. Every stakeholder out there relies on this measurement. It acts as a guide to future investment, a foundational tax base, a guide to dividend policy, an indicator of managerial efficiency, and a solid measure of overall efficiency and creditworthiness. Let's break those down a bit. For prospective investors and banks, this data is literally the enterprise's lifeblood. Current income levels heavily influence their expectations about the future. It guides investors in selecting the right securities to maximize their returns. And for banks, it proves the firm actually has the ability to repay short and long-term debts out of their future income. Meanwhile, the government uses this carefully measured accounting income as the foundational figure to figure out taxable income, which is how they mobilize tax revenues. But internally, it serves as a really strict benchmark to judge the overall efficiency of the management team. It basically shows everyone how well management is acting as decision makers and trustees of the company's resources. And finally, for the owners, correctly measured income is what guides dividend policy. It helps them figure out the exact proportion of current income that should be distributed as dividends versus what needs to be retained to keep growing the business. And crucially, distributing dividends only out of properly measured income ensures that the rights of creditors remain totally protected. You definitely don't want to mess with that.
Which brings us to Section 4, Study Guide Wrap-Up and Final Review. Let's just do a quick final synthesis of everything we've just covered to really lock it in for your exams.
Let's review how these 4 principles work together to wrap this up. Realization ensures revenue is truly earned. Accrual separates cash from the earning process. Matching links the exact right costs to the right revenues. And conservatism, that keeps the whole thing grounded in reality. When they work together, they guarantee our reporting is honest, accurate, and incredibly useful to anyone reading the statements. I'll leave you with this mock exam question to ponder before your test. What exactly happens to our stakeholders, the investors, the banks, the tax authorities, if we just ignore the conservatism concept and report massive profits before they're truly realized? Think about the massive domino effect of bad data. It's pretty wild to consider. Anyway, thanks for joining me on this explainer. Study hard, and I'll see you next time.